As of the market close on Friday, November 28, Nuburu Inc. (BURU) is trading at exactly $0.24 per share, having posted a significant daily gain of 9.85%, or roughly 2.2 cents, with after-hours trading pushing it slightly higher to the $0.25 level. On a day when major indices were largely flat or digesting holiday volume, seeing a stock under 30 cents explode for nearly 10% on volume exceeding 28 million shares is a signal that demands immediate attention. The expectation from the casual observer scrolling through their Fidelity mobile app or checking the biggest movers list on the Robinhood app is that this is simply a dead cat bounce, a temporary gasp of life from a distressed penny stock that has lost the majority of its value over the last year. They see a price below $1 and assume bankruptcy is imminent. The reality, however, is that Nuburu is undergoing one of the most radical and aggressive strategic pivots in the microcap space, effectively transforming itself from a niche laser hardware manufacturer into a diversified defense and security holding company. We are not just looking at a laser company anymore. We are looking at a burgeoning defense contractor that is securing contracts with NASA, acquiring European military vehicle technology, and successfully raising capital when everyone thought the well was dry. The tension here is extreme. Is this $0.24 price tag a liquidation sale, or is it the ground floor of a new defense tech entity that the market has completely mispriced? To understand the ferocity of this recent price action, we have to look at the catalyst that likely triggered this buying algorithm. It isn't just about lasers melting metal, it is about the execution of their new defense and security hub strategy. Just days ago, Nuburu announced the execution of the first tranche of its financial program with Tekne, an Italian defense player. This confirms that the acquisition and partnership strategy is not just talk, money is moving and equity is changing hands. For an investor using a Fidelity brokerage account or engaging in online investment research, this is the proof-of-life signal. The market had priced Nuburu for failure, expecting them to run out of cash before they could execute this pivot. The reality that they are closing deals and integrating new business lines like Orbit SRL, a defense SaaS company, forces a repricing of the risk. If they are not going bankrupt in the next quarter, then a $0.24 share price, which effectively values the enterprise at option value, might be absurdly low relative to the sum of its new parts. Let's dissect the intraday movement we saw on Friday. The stock opened around $0.22, dipped slightly as morning profit takers flushed out weak hands, and then spent the entire afternoon grinding higher on sustained buying pressure. This wasn't a pump-and-dump spike that retraced immediately. It was a consistent bid that held into the close. This typically indicates accumulation by parties who are looking at a longer time horizon than just day trading. We saw over 28 million shares trade hands. To put that in perspective, the float is relatively small. This means the entire shareholder base is turning over. The tired, frustrated investors who bought at $5 or $2 are finally selling out to a new crop of speculators who are buying the defense transformation narrative at $20. For those of you using SoFi Active Investing or Schwab Intelligent Portfolios to track momentum, this kind of volume turnover at a 52-week low is often a classic bottoming signal. It flushes out the overhang of supply, leaving the stock free to move higher on relatively light news. However, before we get too bullish, we must address the expectation that has crushed this stock for months, the financials. The expectation is that Nuburu is a cash incinerator. The reality, unfortunately, supports this view to an extent, but with a major twist. The company's recent Q3 reports show negative shareholders' equity of over $53 million and a net loss of $22 million. These are ugly numbers. But, and this is the reality that the bears might be missing, the company recently completed a $12 million public offering and eliminated 100% of its long-term indebtedness earlier in the year. They have cleaned up the balance sheet to make themselves attractive for these acquisitions. They are trading debt for equity, diluting shareholders to survive and grow. This is why the stock is at 24 cents. But if you're buying here, you're not paying for the past cash burn, you're paying for the future revenue streams from Tekne and Orbit. The market is backward-looking, the opportunity is forward-looking. Now let's go deep into the technology, because this is where Nuburu differentiates itself from every other penny stock on the Nasdaq. Nuburu is the pioneer of blue laser technology. Why does this matter? It comes down to physics. Traditional industrial lasers use infrared, IR. The problem is that yellow metals, like copper and gold, reflect IR light. Think about it. Copper looks shiny because it reflects light. When you try to weld copper with an IR laser, most of the energy bounces off. You have to blast it with immense power to get it to melt, which is inefficient and creates messy welds. Blue light, however, is absorbed by copper 13 times more efficiently than IR light. This means Nuburu's blue lasers can weld copper faster, cleaner, and with far less energy. Why is this relevant to the stock price? 2 words: electric vehicles. An EV battery is essentially a massive pile of copper and aluminum welding together. As the world moves toward electrification, the demand for efficient copper welding is skyrocketing. Nuburu's tech is perfectly positioned for this secular trend. But the reality that exceeds the expectation here is not just cars, it's space. Nuburu has been awarded a Phase 2 contract by NASA to develop power beaming technology. This sounds like science fiction, but it is real engineering. On the Moon or Mars, you don't have a power grid. You have solar panels in one place and maybe a rover or a habitat in a dark crater miles away. Running copper wires across the lunar surface is heavy and expensive. Nuburu is developing a system to shoot energy from a blue laser source to a receiver miles away, wirelessly transferring power. The blue wavelength is critical because it allows for smaller, lighter optics, and in space, weight is money. This NASA validation is a massive stamp of approval. It tells investors that the underlying IP is not vaporware, it is rocket science. For those watching via Robinhood stock trading or checking Fidelity mutual funds that invest in aerospace, this NASA link provides a floor of legitimacy that most microcaps lack. But let's pivot back to the new strategy, the Defense and Security Hub. This is where the story shifts from niche tech to conglomerate. Nuburu is acquiring interest in Tekne, an Italian company that manufactures military vehicles, specifically the Flyer 72 heavy-duty vehicle used by special forces. This is a hard asset. They are moving metal, not just photons. By combining Nuburu's laser tech, which can be used for directed energy weapons or dazzling sensors, with Tekne's vehicle platforms, they are creating a vertically integrated defense offering. They also acquired Orbit SRL, a SaaS provider for operational resilience. This adds a software layer to their business, potentially bringing in high-margin recurring revenue. The logic here is sound. Hardware, platforms, plus software equals a modern defense prime. This is the pitch that Alessandro Zamboni, the executive chairman and new co-CEO, is selling to the market. He is essentially acting as a private equity manager inside a public company, rolling up assets to create scale. If he pulls this off, the re-rating from a hardware component supplier to a defense platform integrator would be massive. Defense stocks trade at much higher multiples than component makers. However, we must return to the risks because at $0.24, the risks are lethal. The primary risk is delisting. The stock is trading well below the $1 minimum bid requirement for the NYSE American. They have received deficiency letters. If they can't get the stock price back above $1, either through organic growth or a reverse stock split, they will be kicked off the exchange and onto the OTC markets. This would be catastrophic for liquidity, forcing many institutional holders like those in Fidelity ETFs or Schwab Intelligent Portfolios to sell automatically. A reverse split is the most likely outcome if the stock doesn't rally naturally, and reverse splits are often followed by further selling. Furthermore, the dilution spiral is a real threat. The recent $12 million raise involved the issuance of millions of warrants. Warrants are like phantom shares waiting to be born. As the stock rises, warrant holders exercise them to sell, creating a constant headwind of supply. This is why the stock struggles to hold gains. Every time it spikes to $0.30 or $0.35, warrant holders might be dumping into the liquidity. For a retail trader on the Robinhood app, you are fighting against this tide of paper. The future outlook for Nuburu depends entirely on the hub strategy's execution over the next 6 months. Scenario A, the bull case. The Tekne and Orbit integrations go smoothly. They announce a major contract win for the Flyer 72 vehicle incorporating Nuburu's laser dazzlers. NASA expands the power beaming contract to a Phase 3. The stock naturally regains the $1 level as revenue jumps from the consolidated entities. Scenario B, the bear case. The acquisitions stifle cash flow. The company